I'm joined in studio by Antoinette. We've had you on before. You were actually only just new in the job in Prosperous at the time when you came in the last time, weren't you?
Yeah, I think 2 days, maybe 3 days.
Yeah, we gave you 3 days to settle in and then we roped you into the podcast.
Yep.
So you look after the mortgage department, team, offering, whatever it is. What do we call it? Keys?
Keys at Prosperous, yeah.
Keys at Prosperous.
That's us, yeah.
And let's just to keep everyone happy and keep us all in a straight line. This is obviously a podcast, but we will be mentioning Prosperous, and I own Prosperous, and Colin is a shareholder too, and you work in Prosperous, and we can't get away from that. So that's what it is. But hashtag ad owned brand, I think is someone wanted to say recently, can you not call it Owen brand?
Owen brand.
So it's hashtag ad own brand. Anyway, so what we're going to do today is a slightly different format to what we've been used to before. We've actually got 4 questions. And we're going to go through them. So these are questions that have come in specifically in relation to mortgages. And we're going to go through them. And you're the expert. I've been around mortgages for a very long time, but you're at the cold face of it. And let's just see what the questions are. I think we just jump in, Antionette. Are you okay with that?
Yeah,
let's just
absolutely.
jump in. Let's go for the first one.
Yeah.
Hi, I've just listened to your mortgage podcast there now. That was out on Wednesday. Myself and my husband are both first-time buyers. Our situation is a little bit different and I wanted to just get some guidance around it. So I have inheritance which is going to be coming into my account in the next week or so. That is the bulk of our deposit for our house. Is that okay? Second question is, the house that we're actually going to be moving into / purchasing is my parents' house. My mum inherited it there a week or 2 ago when my dad passed away and the will went through probate, but we're actually going to move into that house and she's going to move into the house that we're living in at the moment. We're renting from my uncle. So I'm just wondering, is she best off putting the house up for sale and we buy the house off of her? Or I know when I contacted my bank, AIB, they mentioned equity, but that kind of all went over my head. What would be the best option? Should she sell it and we buy it off of her? Or do we go through equity? Thank you.
Okay, so let's deal with the first question first, which was she's just got given a gift of, or she just got an inheritance of some money, which is going to be the deposit for her house. Any issue with the banks from that?
No, not at all. That's absolutely fine. So once you have your 10%, if it's gifted, if it's inherited, the key part is that the tax part of it has been covered off.
If there's any tax due on that inheritance.
That it's paid.
Is there not an issue around the idea that the bank kind of goes, I think she said there, but it doesn't matter if it's specific to her or not. Is there not a thing where a bank goes, here's someone who's just got a lump of cash and they haven't actually put any of their own, I'm sorry, I'm not talking about that person.
Sure.
They haven't put their own effort into building up the cash.
Sure. And there are some banks that take that view in certain cases.
Okay.
Quite specific cases. They want you maybe to put in 5% or half of the 10%. But really it's about you're demonstrating your repayment ability. So if you're, for example, renting and you've got this lump sum that you've inherited or been gifted, you have then the rent will show that you can afford to repay the mortgage. So your DRA or PRA, we call it, proven repayment ability, and your lump sum is fine then once you've got the 10% and the tax piece is covered.
So you've proven your ability to repay.
That's
so
it, yeah.
They really what they want. They just want confirmation that you are able to commit to making a repayment on a month-to-month basis, whether that's savings, whether that's rent, whatever it is. But I suppose with the amount of bank of mum and dad that's going on, they can't really cut their nose off to spite their face. If you're flat to the mat paying rent and you're really struggling to save and someone gives you a gift, does it really matter?
And I think most of the banks recognise that now, that a lot of people's deposits are coming from those sources. But there are some cases where they will look for that input. It might be maybe your loan to value is high and your income level is maybe on a lower level.
Just explain it to everyone what loan to value is.
So loan to value is the amount of the mortgage versus, so the amount of borrowing you're taking versus the value of the property or the purchase price. And the maximum you can borrow in general is 90%.
Okay.
The
So
low-
if you're sorry, Antoinette, but if you're buying a house for 300,000, 90% of that is 270,000.
There you
So
go.
your mortgage, the max mortgage you're going to get is 270,000 on a 300,000 house.
In general, yeah.
In general, yeah.
But
When you say in general, why is there? Do they ever go to above that? They used to.
there is the ability to do that. We don't see it, but there is it's built into that exception rule where the banks are allowed to lend outside of the central bank guidelines in a small portion of cases. It's very rare that you'll come across a bank that will.
And could that actually mean that you can go up to 100%? Technically?
Technically, yeah. But again, I think you're looking at very, very particular cases. You're probably looking at a very particular type of mortgage applicant.
And I'm going to put words in your mouth. So basically, it's if your daddy's the best customer of the bank and your son is looking for it, and your daddy doesn't want you to have to put any cash into it. Yeah, I get
Possibly.
you. It's one of those really, really random cases that might work out.
Very random. And is it something that you really want to do anyway? Borrow 100%. We know the horror stories of what happened. So yeah, I suppose it's not the best advice, but again, a very specific case, you might go down that route. But then in terms
just to make sure people don't go off on a tangent. Mm-hmm. Like 90% mortgage is what it is.
It is. 90% is
there is no.
I
know you've vast experience, and I'll put you on the spot. Is it 2008 since the last time you did 100% mortgage?
And we did a lot of them then. Well, I've probably come across one since then.
Okay.
Yeah.
Okay. Yeah. So they are not
very few and far between.
Yeah. They're not the norm. Okay.
No, absolutely not the norm. And then on the other side of the coin, then when you're looking at a lower loan to value, it's less of a risk, I suppose, from the lender's point of view. So that you're able to maybe get that better interest rate or. Have a little bit more flexibility from the lenders.
And isn't that what the fundamentals of mortgage lending are? Like, there's two things. One, can you prove to the bank or the bank satisfied that you're going to be able to make the mortgage repayments on a month-to-month basis? And you prove that by paying rent for years or saving for years or a combination of the two, right? Yeah. And you can say, and I would always say, and maybe you might disagree with me in this, and please do if I'm wrong, I would always have said you need to show an ability to repay 1.3 times and sometimes even higher whatever the mortgage repayment is. So get onto Google, go mortgage calculator, figure out how much of a mortgage you're going to look to borrow and work out what the repayment is. And to keep the math simple, if the payment is €1,000 a month, you need to be able to show an ability to repay 1.3 times that or 1,300 quid.
That's it, yeah. And that's a good gauge, I suppose. It's a good one rule to follow as you're saving and you're trying to reach this again, the proven repayment ability. And I think what's really important that is showing that you can afford 1,300 in that example, 1.3 times €1,000. What you're actually saying to the bank there is look, between my rent and my savings, or all of my savings or all of my rent, I can show you that over a long period of time, whether that's 12 months or 5 years or whatever it is, that I've been consistently been able to put away that 1,300 quid a month. The bank then goes, oh, that's a lot of comfort for me because the mortgage is only going to be 1,000, and even if interest rates go up, and I'm not talking about where they're going, I'm just saying in general, if interest rates were to go up, there's still a bit of buffer there and a bit of comfort for them. So that's the first side of the foundation of when they're making a decision. But the other side is what we're talking about a second ago, which is 100% mortgages. They want to see that you've got a bit of skin in the game. Exactly.
Right? And they want to make sure that if you borrow 90% of the purchase price, again, using our example of 300,000, you borrow 270. They want to make sure that you've put some money down so that you've got skin in the game and you're not worried about losing, that you're as invested in the property as they are. And with a 100% mortgage, you're less invested in it because you didn't put in your own cash into it. More important for the bank, they want to make sure that if they have to take the house off you, that they're going to be able to sell it, cover their legal costs and clear their mortgage.
There is that buffer in terms of the value.
Yeah.
So to sell it on, absolutely. I think loan to value is it's a funny one. Again, if we go back 15 years, 10 years even, even 90% mortgages were, and still are, I suppose, put through the ringer, making what we call stress testing. So When you say that 1.3 times, some of the banks will actually stress test at a particular rate. So they might say, well, our stress test rate is 6.5%. That doesn't matter if we feel that rates could be dropping this year or next year or whatever. They'll still stress test it at the higher end.
So what you mean by stress testing is you're basically saying the mortgage rate might be 4%, and that's the mortgage you're getting. And please, people, don't read into what I'm saying in terms of rates. I'm making these numbers up as I go. Your actual mortgage rate is going to be 4%, but we want the bank stress tests. And what they mean by that is they look at how would you survive if the rate was actually 6.5?
Yes, exactly.
And they're looking at and saying,
pushing you kind of to your limit. Are you still going to be able to afford this based on your income? And have you proven to us that you could afford that level if tomorrow rates went in that direction?
And that's why the 1.3 times is important.
Yeah.
I do remember, and I don't know how, when it comes to exceptions, I do remember a situation where I know it changes on a day-to-day basis often, but where there was one bank in particular was saying, I'm not giving you an exception where we're going to break the central bank rules unless you can show 1.6 times.
Yes.
And it can change, can't it?
It can, yeah. And individual banks will set their own policies, and their policies can change regularly, individual banks. There is the central bank guidelines, but within the banks, they have their own internal lending rules and policies. So that can be a thing, absolutely. If we're going to do, if we're going to look at an exception for you, let's show us that you can. This is not. There's no question around your repayment ability.
Do you know what, Antoinette? Right, we're now kind of 10 minutes into this, and we've only answered the first question. Right, we may not get to all four, so let's try and get another one in and see what the difference is. So there was a second part to that question, though, wasn't it? And that was, and I remember what it is. It's got to do with, should the mother put the house up for sale? What the mother, they don't have to put it on public for sale, right? They don't have to do it. They can sell it directly. But what you need to be careful of there, from an inheritance tax point of view, from a gift tax point of view, is if, say, the house is worth €300,000, and if there's any discount there, right, if they sell it to you for €200,000, on paper the house is still being sold for €300,000, and the €100,000 is considered a gift.
Yes.
Okay, and that comes out of your inheritance tax allowance, which is $335. Not only that, and in this case, it sounds like the mother, it's the family home. Yes. Right? So she's disposing of the family home. So she's not going to have any taxes to be paid on the disposal of the family home that she's been living in. But sometimes I've come across it where, let's say, mum and dad own an apartment, just to make it up, and it's worth 300,000, and they sell it to the child for 200,000. There's a €100,000 gift there that needs to come out of the child's inheritance tax allowance. But the parents will be taxed based on a 300,000 sale price. Yeah. And they're going to pay the tax on that, even though they only actually got 200,000 in cash into their bank account. Yeah. And you need to be very careful of that. So they don't need to put it on the public market. They don't need to put it up for sale. But you do need to get an idea what the actual real value of it is, and just be careful around that gift, and that you're not getting caught up with taxes there. And
I think when you go to get the mortgage, you'll get a valuation, and the valuer will be an independent person who will put a value on it, the open market value. So that's where that gap might arise. So again, talking about the 300 and the 200, and then the bank will want to make sure, again, that that's been covered off, that you are tax compliant, or you've paid anything that's due.
Okay, let's go for question 2.
Hi, Antoinette. We're probably a good 2 months away yet from applying for mortgage. We were just trying to get a few things together. Just wondering, I'm a first-time buyer and my wife is a second-time buyer. How does this work for when we're applying? Will my salary be multiplied by 4 and hers multiplied by 3.5, or will it be, or is there some sort of average taken, or how does it work at all? Thanks.
Go for it, Antoinette. You jump in there.
So no, you guys are now considered second-time buyers for the purpose of that calculation. So it's going to be 3.5 times your combined gross salaries. So it's fairly straightforward. That's with the banks, and I think all of them would consider you second-time buyers now, because one of the
and just to explain what the calculation that people are doing there. So say if you're on 50 grand each, that's a combined salary of 100 grand. And they multiplied that by 3.5 times, which means you can borrow up to 350,000. Now, if you're 62 years of age and you need to clear off the mortgage by the time you're 65, you're not getting 3.5 times, right?
Or if you have dependents, or if you have other financial commitments,
But the maximum that the central bank guidelines allow the bank to give you is 3.5 times as a second-time buyer. But as a first-time buyer, on 100 grand combined, you could borrow up to 400,000.
Yes.
Okay, so it's 4 times the 100,000.
There is one exception to that. And it's called a fresh start.
Yes.
So so that it depends on your circumstances. So if
you're divorced, really, is it?
Yeah. So if you're starting over and you have no interest in a property, so if a relationship has broken down, usually is the times that we've come across it. But you've no more interest in that property. It's been disposed of, or it belongs now to the other party.
And fresh start isn't just about divorce. It could be that you're in a durable relationship,
yes,
and you've separated now and you're not together anymore,
yes,
and you no longer have an interest in that previous property. You're not treated as a second-time buyer.
Exactly.
So basically, the central bank have got caught with the times, and they're willing to recognise durable relationships.
They are,
but the taxman isn't.
Yes, there you go.
Yeah, okay, that's nice. You know what? Actually, let's just jump on to the next question, because
Sure.
I would like to try and get through them if we can.
Sure.
And I'm wondering still, are we going to have to dump one? Let's see what happens.
Okay.
Hi, Alvin. This is Jana. I'm in the situation where I'm about to buy property under affordable purchase scheme. I never had a mortgage in my life, but I did own property in Ireland for around 3 years. I'm also a single parent. Apparently, I'm not entitled to help to buy scheme because I did pay local property tax before. So first question is, could I get a clarification on that? And is that right information that because I paid property tax, I can't get help to buy scheme? And is there any way around it? Second question that I have is, what are the biggest risks buying under affordable purchase scheme? And the last one is, I'm renting at the moment. So ultimately, am I doing the right thing by buying under affordable purchase? Thank you. Bye.
Okay, I'm going to answer the third one first,
Okay.
and then you can take the other two if that's okay. So what I would say is this applies to everybody. If you're thinking of buying and you're worried about house prices going up or going down or going left or going right or whatever you're worried about, the first thing I'd say is and I'm very much on record as saying this, anybody who tells you what's happening to house prices in the short term is guessing or lying, right? Nobody knows what's going to happen to house prices in the short term. And the second thing I'd say is, the general advice I would give, if you're thinking about buying a home, if you can afford it, you love it, and you're willing to stay in it long term, don't worry about where house prices are going to go. Because if you can afford it, it means that's great, and you're going to be able to make the repayments on a month-to-month basis. In 3 years' time, if house prices fall apart, you can still afford it. And it doesn't actually matter how much the house is worth unless you're selling it. And if you're willing to stay in it long term, and I'm talking about 15 years plus, then it doesn't matter where the house prices are, because we haven't had a 15-year period where you would still be down 15 years later. In fact, we just scraped through from 2008 to 2023. It was just back to break even again. But what I would say is that you love it, you can afford it, and you're going to stay in it long term. Everything else is just noise. And I would always encourage people to buy then in that circumstance.
Sure.
So that's the answer. Her last question was, what should I do? I'm renting. Is it the right thing to do to buy? And I'm guessing, I'm kind of reading into that, maybe she's worried about where's house prices going or what the story is. But do you want to take the first two?
So the first two, I think the first part was about the help to buy and that she was told she won't qualify for it. And I'm not a tax expert, and but my understanding is if you've owned a property, you won't qualify for help to buy. And I think there is an exception to that. If you inherited or were gifted that property, there is that's the exception. If you bought that property with cash, you won't qualify for help to buy. Even
under Fresh Start?
No, not as far as I know. But
okay.
I am open to correction on that. I'm not the tax expert, and that's revenue. So yeah, that's my understanding of it. And I'm assuming Jana has maybe made that contact with revenue. One
of the things I'd say about that is if somebody else has been in that circumstance and in a similar circumstance to Jana, and you did get help to buy, can you let us know? Is the thing I'd say, because
that would be great.
That would be brilliant, and we will make sure that we publicise it across Instagram and TikTok and wherever else we publicise stuff. But that's often one of the places that I find my best answers, is that you find anyone else ever been in this position, and you find out, well, actually, this is how I got around it. So if anyone else has been in that position, they can share some knowledge with us. That'd be great. Yeah, great. The second question. The second part was about the affordable purchase scheme, which is a local authority scheme. And was her question, was it the right thing
to do?
Should she do it? I think there's a general kind of, when you think about like things like shared equity scheme, the affordable home scheme, all of these things, people often ask, is it the right thing to do? Should I stay away from what's the problem? Like, and the way I look at it is, if it's right for you, do it.
Yeah.
Right? Like, particularly like if you think about shared equity, like I think that's brilliant for the individual. So for people who don't know what shared equity is, typically you buy, I think it's 70% of the house with the bank and the government buys 30% of the house.
Yeah.
And after 5 years, you start paying them a charge. They won't call it interest or rent or anything else, but you start paying them a charge after 5 years. And you can pay the charge on a year-to-year basis, or whenever you sell the property, you give them back their 30% and you pay the whatever charges haven't been paid. And what I would say about those schemes is, if it works for you, it's absolutely brilliant for you. Now, for society, I think it's crap, right? I don't think it works in terms of our house price has just been driven up by 30%. Is that ultimately what's happening with them? So I think sometimes, like, I'm really sorry, it's really hard to buy a house and you do need to be a little bit selfish when it comes to it. In terms of, I really don't think you should put your societal, I'm going to do this for society and not use the shared equity scheme or the affordable housing scheme because I'm worried about society. No, just get your own front door sorted out first, and then let society deal with the rest of the problems.
The bigger picture.
Yeah, the bigger picture. And these are the tools. These are the rules we're all playing by, and go and use them, is my opinion.
Yeah, and if it, if it works for you, if it's a way that you can get those keys in your hand and a home that you want to be in, it's a good option. Yeah. So particularly the affordable purchase scheme is it's a property that the local authority are giving you at a discounted price. Yeah. But again, you will ultimately pay that back.
Yeah, you will pay it back in the end. Before we go to the next question, I think we've only one left, is it? We're on three. Before we go to the next question, I have a question I'm going to throw you at, and I just left the field and you don't know that this is coming. How's the landscape at the moment for somebody who can't get life cover because of, say, they've medical problems and they just can't get life cover? Is there any banks that will give them?
So it's always a tricky one, and very much case by case. So if your particular circumstances are, for example, you have cover through work.
Yes.
So it's about looking at the mitigants. Maybe I think that's probably the word we use. Is there anything else then we can offer the bank to soften the blow? Yeah. Because the normal course of events, the bank wants you to have life cover, that the policy they'll take and will pay out if you were to die during the course of that loan. So if you can't get that, again, if you were applying by yourself, it's riskier than a joint application where one party can get life cover and the other can't. So if you, so in that scenario, you, again, a mitigant might be, well, the other party who can get life cover is earning a strong salary, and do you know what I mean? So
basically it's about trying to reassure the bank that if somebody does die, that they're going to be okay.
It is.
But it's not a blanket no. Sure, it's not.
It's not a blanket no. And nothing usually is. We always try and work with what we have, I suppose. So I would always say, if you think it's look, I'm out of the running, don't leave it there. Make sure we've checked for you. Make sure your broker has checked for your bank.
But isn't this a perfect example of where a broker comes into their own? I don't know. Look, if anyone wants to accuse me of, you would say that own, right? But it's a perfect example of, you could go to Bank A and they say, you know what, we're absolutely no chance. And if you only walked into that bank, you think that that's what they all think. Whereas you walk into a broker, you're walking into all the banks. Yeah.
And you've got people who know that general landscape. So, if you work in one bank, you only know the rules. As a mortgage advisor in that bank, you only know what that bank will or won't do. So as a broker, you have a wider picture, But I suppose, back to your question, if it was a single person buying by themselves, could not get life cover, did not have any cover with their job, maybe like a death in service, it would be very hard to get that mortgage drawn down.
Okay, let's go for the last one. Hopefully it's a quick one.
I have a question about getting a mortgage. Now, me and my partner were on a combined salary of 84,000 a year. We have 2 kids. We're currently private renting, and just, everyday life and paying the rent, no HAP assistance payments or anything like that. Just everything coming out of your own pocket and earning the money as you should. Like, we're kind of finding it very, very hard to kind of successfully put money away or feel like it might be a possibility for us to actually get a mortgage. Well, I think we'd potentially get one, but the whole deposit side of it is a real big issue for us. Now, like, I have looked into the Help to Buy scheme, and I think even on my own, I'd qualify for the full amount because I would be the higher earner in the household. My partner's salary wouldn't be really great, but combined, they make two average salaries, whereas mine on its own would be a very good salary. Like, but what I would like to know, could you tell us a way to successfully use the tools we have, like the Help to Buy and maybe the shared equity scheme, and get into a house with the smallest deposit possible? Like, it kind of does feel like that's our only hope of potentially being successful and getting one. Now, I am starting to get on top of money a bit as the months go by. There's a little bit more in the account every time I get paid and whatnot. So there's positive changes getting made, but we still feel like we're a very, very long time away from actually getting a house.
It's such, like, that's a story that will resonate with everybody, isn't it? Like,
absolutely.
the amount of people in that position, they're just trying to get by day to day. They're able to pay the landlord's mortgage for them because they're paying their rent on time every month, but they just have no money left at the end of the month to start putting aside for savings. And it's such a treadmill to be stuck on. It's so hard.
Yeah, it really is. And you know, all well and good, banks looking for this 10%, but where are you going to get it when you're paying the crazy prices that we're seeing in rent at the moment? The tools you spoke about, I suppose, are really, really useful. They're aimed at the new builds, though. Let's be honest, it's going to be a new property that you'll buy. The Help to Buy scheme, first of all, he's mentioned that he thinks he'll qualify for the full amount. So that's potentially up to €30,000. And the first home scheme, which is the shared equity scheme we spoke about earlier, that's useful in bridging that gap. So where you could get a mortgage from the bank for X amount, you have your Help to Buy, you maybe have some deposit as well, and there's a gap to reach to be able to buy that new build, and the shared equity bridges that gap.
Yes.
So two very useful tools, but mainly focused on those new builds, which are few and far between.
Yeah, and a little bit more expensive. Yeah.
The exception to that is the first home scheme has an option if you were to buy from your landlord. So where you're renting at the moment, if your landlord is asking you to leave, that he wants to sell up, they have to give you your notice to quit, and potentially you could qualify for that first home scheme in that particular circumstance.
And this is something that it was about 12 months ago a semi-campaign, if you want to call it that. Got a bit of traction at the time. I think I spoke about it on radio, where I was trying to argue that really for people in this very specific circumstance, where they're just struggling to get their deposit together, why can't we turn off the rent? If you're going to buy from your landlord, let's wrap it up in legals, agree the sale price today. So you're agreeing £300,000 purchase price. That's what I'm buying it off you for. And over the next 12 months, and a kind of rent to buy, or that you would pay the rent, that the landlord, the scheme or the structure I was proposing was the landlord would get a reduced rate of tax on the sale because they're selling to a sitting tenant. That the rent now immediately becomes a payment on the deposit, and the smaller rate of tax that's applying to the overall sale is now being built into that. And it allowed people then to pay the rent, build up the deposit using their rent over the next couple of months or year or 2 years or whatever the scheme works out to be. And then ultimately the landlord's looking at it going, I was paying 50% tax on this, and now I'm paying 20% tax, or whatever the difference in the tax rate and whatever's agreed. And ultimately the bank will be satisfied in a couple of months' time or year time or whenever it is, because the person has the skin in the game, the loan to value is right, and everyone's a winner. And it's such an easy thing to do. And even you don't even have to make it tax incentivized. You just create the structure and the legal framework around it to allow the banks to recognise that the rent that you've been paying, which is actually not rent anymore, it's a deposit. It's eaten into that 10%. And once you've reached 10%, you buy it and you're done.
Yeah.
And there's something in it for the landlord, there's something in it for the tenant, and everyone moves on. But we got a bit of traction, or I got a bit of traction at the time. It hasn't got anywhere. If there's any government ministers or future government ministers out there want to talk to me about what I meant by that, because it's not as clear as it was when I put it together about a year ago. But there's definitely something in it. Yeah,
there's definitely some tricks being missed, I suppose. And look, renting is one of the toughest positions to be in. Yeah. You've got that lack of security as well. Yeah. So let's do something for.
You don't even want to paint the walls because you're never going to see them fade.
Yeah.
Like like 82% of people in Berlin, I've said this before, rent. That's the last figure I have. 82% of people in Berlin rent. But when you're a renter in Berlin or in Germany or actually across Europe, you can be fairly sure you can still, if you pay your rent every month, you're still going to be in it in 20 years time if you want to be.
Yeah.
And we just don't have that. No, we don't have it at all. And it makes it very different. Antoinette, we could keep going about this all the time. We will definitely we will have you back in for next series. I really appreciate your time, and I will recognise it is a Saturday. You've come in on Saturday afternoon, we're recording on Saturday. You've come in on Saturday afternoon, and I appreciate it. And well done with the people you're helping so far in Prosperous. It seems to be going well for you.
It's going really well, yeah. Lots of nice stories, lots of nice success stories, and people seem to be really happy with what we're doing. So we're growing the team, and so working out good so far.
Well done. Thank you very much. Thanks for coming in.